Well, hello everyone. Welcome to our fireside chat with Kenneth Gao. He's one of the founders and managing principals of Hong Kong-based private equity firm Gao Capital, which focuses on the real estate markets in Asia. Well, Kenneth, thank you for taking the time for us. So let's just dive right in. I think the first question lots of people will be asking is what do you make of the outcome of the US election? I mean, does it change anything for you or for Gao Capital?
So first of all, I don't know if there's an official outcome yet because it seems like there's been no concession yet. But it seems like there's a Biden victory and a Democrat victory. I think our view is probably similar to the mainstream media that there is no so-called blue wave. It looks like the presidency is going to the Democrats. To Biden, and most likely scenario is you're going to have more normal diplomacy for both China and the West, and there'll be less kind of like sensational type of headline. But in terms of strategic rivalry with China, we think that will continue. But as long as the Democrats don't get the Senate, most likely a lot of those more socialist type of promises during the campaign probably will not be passed. Now, of course, we don't know that for sure yet because there's still the runoff in Georgia, and there's still a chance that the Democrats may get the House as well. So there's still a risk of the socialist policies, higher taxes, and all that happening. But it looks like we may be safe from that. But I think most importantly for real estate is that interest rate will remain very low. The Fed has already said that interest rate will remain close to zero until 2023. And I think more than anything else, that's probably the best support for real estate.
So let's talk about Hong Kong in particular, where you're based. You've just acquired City Plaza One with other partners for 1.3 billion. So, maybe take us through, how do you see the real estate scene play out over there?
Okay, so for Hong Kong, I think similar to what I said about the US in that US interest rate will remain very low until 2023. The Fed already said that. And since Hong Kong dollar is pegged to the US dollars, we will follow also the US interest rate. So again, that would be very supportive for the Hong Kong real estate. The other thing is with the Biden presidency, there will be a lot less kind of sensationalist, headline grabbing type of policies. Some of these bills that Trump and the Republicans are trying to pass, we may not actually see that. Some of these bills about Hong Kong that we've seen during the summer may not get passed after all. But most importantly, we feel that Hong Kong will remain as the main international financial center for China. So the fundamental things like one country, two system, English common law as the principle of law, English language is the principal business language, and Hong Kong being the lowest tax regime in China, all of these will still be in place until 2047. And the other thing, freely convertible internationally. So all of that cements the place for Hong Kong as the main financial center for China. And if you look at people in China are still making a lot of money. If you look at the latest Forbes billionaire list that was just published, I think a few days ago, they were talking about the China billionaire list is now 2.1 trillion in terms of the net worth, compared to just 1.3 trillion in 2019. So that's an increase of something like 850 billion, compared to the US list was only increased by about a third of that. And the number of new billionaires also increased by like 64 people compared to only 18 on the US list. So people in China are still making a lot of money. And as long as that happens, a lot of this wealth would still flow to the main international financial center, which is Hong Kong. Now, people talk about the national security law. People talk about maybe China is putting more control in Hong Kong, that people are worried that maybe some of the, especially multinational companies, regional headquarters may leave. Some of the long-term expatriates also may leave. But most important for Hong Kong is our relationship with China. As long as Hong Kong remains the freest place in China for both people and for money, and as long as we have the lowest tax rate, we will remain the international financial center, and the wealth will still come here. So we remain very positive and optimistic about Hong Kong, and hence our latest. I think our latest acquisition also, we're putting our money where our mouth is.
Right. I mean, having said all that, though, we still see how hard that COVID-19 has hit, the travel, hospitality, retail, and office property sectors, with the lockdowns and the other restrictions. Just wondering how the assets in your portfolio are performing, and I mean, how are you protected from the downside?
Well, obviously, the biggest effect is hospitality. There's no real escape from that. Whoever is in hospitality, pretty much anywhere in the world will be affected. We have like 30-something hotels around the world. And at one point, at the worst time during the COVID-19 lockdown, I think 30 out of 33 hotels we have were shut down. Now, many of them we have reopened. Some of them doing better than others. Some of them like in Singapore, we actually have pretty good business from Singapore companies paying for their Malaysian workers to stay in Singapore, so that they don't have to go back and forth and be subject to quarantines or other restrictions. We have certain hotels in the US, which are kind of drive to holiday locations. Those have actually done pretty well. We have similar type of hotels in Thailand, like in Pattaya, where we get very, very strong weekend traffic from Bangkok. So those kind of hotels do pretty well. But all in all, I think hospitality is the biggest hit. And we think that so far we haven't seen actually a lot of distress yet in that sector, probably because of globally, a lot of the central banks of the world have been giving a lot of monetary support to the market. And the banks haven't been really pushing creditors too much yet, or debtors too much. But I think with year-end valuations coming, so maybe a lot of loan covenants will be breached. And if there's persistent kind of negative cash flow, I think maybe first half of next year, we may see some distress in that sector. Some other sectors which are, I would say, facing pressure would be like retail, especially retail which is tied to tourism trade. Fortunately for us in Hong Kong, most of our retail are actually community shopping malls. So our shopping malls actually service the local community rather than tourists. So our anchor tenants are people like supermarkets, fresh food, wet markets, convenience stores. So these trades actually did pretty well during COVID because people stay at home and they need to buy more food, they need to buy more stuff from convenience stores. So those have done pretty well. So I think on the retail side, we are fairly insulated. And then in China, actually, interestingly, our main retail exposure is in outlet malls. And these are kind of I guess a combination of domestic tourism and consumption. All these malls that we have are built kind of like European style villages. And the tenants are major brands like Gucci, Prada, Burberry, Moncler, these kind of brands selling discounted goods. So with a lot of Chinese citizens not able to travel out to Europe, to Japan, to Hong Kong to shop, we actually have been doing very good business. In the last 3 months, we have about 6 of these malls in China. We're doing on average about 30 to 50% higher turnover than same months last year. So it has actually done pretty well.
But I mean, overall, though, what would the impact be on your returns or even your exit strategies?
I think the main impact would be on hospitality. Okay. So there are a few hotels which we have brought to. We bought it a few years ago. We've done our value add upgrading work. They have been growing well, and couple of them, I think, we have planned to be exiting this year. Obviously, we're going to delay that. It's just not a good time to be exiting. We'll still make money, but I think for sure it's going to impact our return in those kind of deals.
Right. So I know you said that we haven't really seen much distressed opportunities yet, but I was going to ask, in 2015, you took over a Vietnamese real estate portfolio specifically, reportedly at a 50% discount because of poor market conditions in Vietnam at that time. Eventually, as the central bank stimulus and all eases off, are you expecting to do similar deals or expecting them to surface at least in the coming months?
Okay, so on that particular fund, we bought a portfolio of 4 assets, and we have actually sold 3 of them already. And from the sale of the 3 assets, we have already returned double the original investment. So we have been, it's a 2 times profit with actually the 4th asset still in our hand. And that 4th asset is actually a hotel. So it's one of the hotels I was talking about that we were planning to exit this year, but we're going to have to delay that until the market normalizes. But yes, that was a particularly good deal, I would say. We actually struck the deal in 2014, but it took like, I think 9 months to almost a year to fulfill all the condition precedents and all that. So we closed the deal in 2015 when the market was already on its way up. If you're asking me about Vietnam, I would say Vietnam actually is a hot market, even with COVID. It is a market with the highest economic growth in Asia right now. It is also a direct beneficiary of the US-China trade war, with a lot of the manufacturing from China moving there. You see Samsung moving their entire cell phone production to Vietnam from China. And also a lot of the light industry type of manufacturing from China also moving there. So it's a big beneficiary. If you ask me about Vietnam, I don't really see that we will see the same kind of opportunities we saw in 2014. Because in 2014, the Vietnam market was just coming out of the previous crisis. They had a major crisis in 2011, 2012. We are not in that situation right now.
Right. I mean, sticking with Vietnam, having said that though, everyone is bullish on Vietnam, but it has its challenges, regulatory and currency challenges. And I think exits for some of the PE investors have been tough. I mean, you manage a Vietnam specific fund. So in that sense, based on what you've said, what sort of returns are you expecting, from investments in the country?
So like I said a little bit earlier, in that first portfolio, we actually exited 3 out of 4 already. And we had been, I think we were getting, let's call it on average about high 20% IRR. So it's good IRR. And if you include the 4th asset that we will sell, it will be higher than that because we're already at 2x with selling just 3 out of 4 assets. With the remaining assets, and those 3 exits includes both exiting domestically and exiting some to foreign investors. So we've done both domestic and foreign exit. So I think it's possible to sell as well, not just investing. And for the remaining assets, we have a mixture, like I said earlier, with hotels, we have residential development, we have office buildings, and we have industrial development. The residential market is very hot. We have a major development in Ho Chi Minh City. Right now it's on its 4th phase already. So the last 4 years, each year we launch a phase. And the market price has gone from the first phase is 2,600 per square meter, US dollars. Second phase was 3,003. Third phase was 5,008. And the latest phase is selling at over 6,000. So you can see the kind of pickup, right? It's the same kind of growth we saw in let's say Shanghai or Beijing or Shenzhen in the last like 10 years. And we saw that in the last 4 or 5 years in Vietnam. So it's a strong market.
Yeah, but you can't be the only you can't be the only investor, looking at this opportunity. I mean, what's competition there like? So I mean, how do you see competition? What kind of impact does it have when it comes to looking for assets, the quality assets?
So far, the competition is more local, actually. There are some foreign investors there, but not nearly as keen as what we have seen in China or let's say Japan, those kind of markets.
Okay.
I think probably because the size of the deals, a lot of the foreign investors may consider the size of deals in Vietnam too small for the trouble, because it is a good market, it is strong macroeconomic growth, but it's not an easy market to navigate.
But it's a matter of time, wouldn't it be, more or less, before I think the market?
Yeah, look, if the market grow to be big enough that it is worthwhile for people to pursue, then there'll be more competition. But more competition also means that whatever we have in our hands would be easier to exit at better pricing too, right? So it's always like that, right? In terms of investment, there's always two sides of it.
Yeah. So what about VC deals? I mean, in June this year, you took part in the Series A funding for Prop Z, a prop tech startup. Are we expecting more VC type deals?
I guess in the last few years, we have also, in addition to our regular real estate funds, we have also raised a few vehicles which can participate in PE type opportunities, in particular opportunities which are related to real estate. So Prop Z, obviously, it's a O2O residential brokerage company in Vietnam. In fact, we became interested in this because we also invested in China, in Baker, in China. Similar type of company. Of course, Baker is a much bigger company, but in terms of the type of business is similar. That's why we were interested in it. And Prop Z is the leading O2O residential brokerage platform in Vietnam. And we have, so right now we have, amongst our various funds, we have about $300 million or so invested in PE type of operating companies. And most of them are real estate related or prop tech related.
So in this sense, where do you expect it to expand any more into prop tech? What about healthcare? I mean, you've invested in Tencent Trusted Doctors, I think.
Yes. Yeah, and in fact, we have also about $200-300 million in some other types of PE types deals, which may not be real estate related, and those are on our own balance sheet. And that includes the Tencent DoctorWorks that you mentioned.
I was going to ask you also about.
But because of those vehicles that we have raised, it has now been mostly committed. Some of our investors are actually topping up for new vehicles. So we are actually raising a new vehicle for these type of investments too.
Right. So like the education focused fund that you've also raised recently, maybe you can tell us a bit more about that. I mean, how does it fit into your larger portfolio strategy?
Okay, so education fund
that is still real estate.
Is another vehicle. We raised $500 million for especially focused on real estate. It will be investing in both PropCo, like property side, and also investing in the operating side. And that also includes education tech type of businesses. But I think we budget about 3/4 would be in property related on the education side. The first investment for that fund has been in an art school in Guangzhou, which we actually developed ourselves right next to our Florenza Village outlet mall in near Guangzhou. That was just open. This is a grade 10 to 12 specialized art school, and it was just opened in September this year. And we also invested in the OpCo in that deal as well. And we have already identified a few pipelines to expand this concept within China. In addition to that, we're also working with some well-known English boarding schools on school projects within China and also in Vietnam. And we also invested in another school project in Vietnam already as well. So far it's been China and Vietnam, but we're also looking at other Southeast Asian and North Asian markets.
Yeah. Just very quickly, you mentioned something about edtech. Edtech is still quite highly specialized. I mean, like you said, the sector is very hot. But so, how do you intend to navigate it? From with your expertise.
So we have a dedicated team for our education platform. They are looking mostly at the property side, but as we look at property side, we will also get exposure to companies which is in the operation side, including edtech. And I think if you look at this whole COVID situation, people like us have been working from home, but students have been also studying from home. So with a lot of this online kind of education, online studying, it has really accelerated the trend to use technology to study remotely. Obviously, good teachers and good tutors can reach a lot more students through these technologies. But also students can employ technology to help themselves study. So for example, there will be customized tests which can identify students on which are areas of their weakness. You can take a standardized test, and just from the test results, the AI can identify what you're weak at. And you'll be fed more of those kind of questions to get you, to let you target your weaknesses in a customized way. So there are many ways that I think technology can help education. And I think there's a future trend. So it's something that we would be interested to invest into.
You mentioned another vehicle earlier, for non-real estate investments. I mean, what themes are you looking at? What themes will the fund back? Where are you launching it?
Actually, it's still going to be real estate related. So okay. I think I mentioned earlier, when you asked me about Prop Z, I was also talking about Baker, which is right. Baker is the largest O2O residential brokerage in China. So that's one of the examples of companies that we invested in. We took about $100 million in the D round, I think a little bit less than 2 years ago. And that company was just listed this year in August. So that has been actually a very, very good investment for us. We have also invested in the past in co-working. We invested in Naked Hub, which was sold to WeWork and became part of WeWork China. We have also invested with Tencent in Tencent Trusted Doctors, which actually started also as a real estate related deal, in which we help them build physical clinics, and Tencent would contribute their online customer base as patients, and also brought in doctors, physicians, to give online consultation to these clients. So most of the deals that we invest in would be somehow related, has a relationship with real estate.
Where your expertise is, basically. Yeah. Okay. How large is this fund going to be, or is it?
So the first batch was about, is actually separate into 3 separate accounts, and together about 300 million. And I would say it's about 80% invested already. So we're actually raising new vehicles because a lot of our investors are re-upping. From those vehicles. Okay,
let's shift a bit. Talk about the IDCs, the data centers. You've just raised 1.3 billion for this China-focused IDC platform. Do you see other opportunities in other geographies, such as in Southeast Asia? Are we looking at similar vehicles for data centers?
Sure. And yes, in fact, indeed, we are right now looking at raising a IDC platform outside of China. So it won't be just Southeast Asia. In fact, I would say the bigger part of the investment will more likely be in North Asia, like Korea, Japan, Hong Kong, Taiwan, which are actually larger markets than Southeast Asia. But in Southeast Asia, we will obviously also look at Singapore, Indonesia, and some of the other markets. But I think probably North Asia will be bigger. We have bigger representation than Southeast Asia. But generally, we like the data center industry. It is a clear beneficiary from COVID, work from home. And even before COVID and work from home, obviously, with technology advancement, whether it is 5G, whether it's AI, and the global growth in e-commerce, online learning, online games, all that, using a lot more and more data centers. So it's something that you see secular growth around the world.
Mm. I want to talk a bit more broadly now. I mean, we have about 5 minutes left to go. Just how the pandemic, has informed, and its consequences has informed your investment process. I mean, the restrictions in the real estate industry, for example, how should industry players adapt?
Well, in terms of physically, obviously, we can't really travel very freely. In fact, I haven't left Hong Kong since March of last year. So I cannot go visit deals. During COVID, we actually did a few deals. We bought 2 buildings in Japan, and both of them were done because it's buildings that I've seen before, actually before the COVID, and we actually lost in the bidding on those buildings before, but the winners of those bids were unable to close during COVID. So the sellers came back to us, and we were able to get them at a lower price than before. So those, obviously it made sense to us, because we know those deals already. We've also done a bunch of deals in China, in logistics and in data centers. We have a big team in China on the ground, so we have people that can visit those sites. And also and these are platform deals, so we know the operating partners already. And given the sites, they are empty sites, it's quite easy to get a lot of information just from drone videos and Google Map type of shots. So we're able to do those kind of deals. But there are also deals that I wanted to do in places like Australia or even Singapore. We wanted to do, but because I couldn't visit there, it became very hard. And there's some deals that we think is good, but because we couldn't visit, and so we had to be probably more conservative than people who are on the ground, and we actually were not competitive in our bids. So yeah, I mean, there are definitely effects on that.
But what about like the fundamentals of the real estate industry? I mean, the utilization of the buildings. I mean, are we expecting to see some kind of shift? And therefore, as real estate players, what should we be looking at?
Okay, so I think different people will have different kind of views. My view and our view generally is that in the long term, things will revert to the norm. I think people have been talking about remote working for a long time already. If you remember, maybe you're too young to remember, but in year 2000, let's say 20 years ago, during the last dot-com boom, a lot of experts were already predicting the peak of office demand in the world, because with technology, people can work on the beach, in the mountains, at home, and whatnot. This is 20 years ago, people predicting already. Yet the last 20 years, demand for office has been stronger than ever. In 2001, after the 9/11 attack, people predicted that no one will want to work in tall towers anymore because people are afraid of terrorist attacks. Yet in the last 19 years, tall towers went up around the world, and there's plenty of demand for them. I think human nature is that they want to be together, they want to be sharing ideas. Now, of course, in the short term, there may be companies that would experiment with some flexible work arrangements, maybe allowing people to work part of the week at home and part of the week in the office, or shifting some of the departments to totally work remotely. It's possible. But I think they will eventually find that the best employees would prefer to work in the office, where they can be sharing good ideas with other smart people. And most importantly, I think your best employees who want to be in the office to show to their bosses how hard they're working and what kind of leadership qualities they have. And the contrary, people who are not the best employees are probably the ones that would prefer to be working remotely. So I think over time things will revert to the norm.
Right. I mean, interesting point of view. Just a last question, actually, in related question is, what about the valuation metrics, that were employed before in assessing those investments? Has anything changed at all, given even if you, like you say, we do go back to the new normal, but there would have been some shifts in behavior, jobs, for example, companies have downsized, do those metrics that you employed before, do they still apply?
So for some sectors like hospitality, I think for sure the cap rate is going to go up because the whole industry has been exposed in terms of the riskiness of the short-term tenancy nature, right, of the industry. So that one is very clear. For office sectors, different people will have different views. I think in the short term, yes, I think there will be some adjustment to a higher cap rate because people may think that in the short term there will be less demand for offices. But on that, you're also cushioned by the longer term nature of the tenancy. And also you're cushioned by the very, very low interest rate that, that the central banks around the world are supporting the industry. So I think it's probably on the commercial side, let's say office buildings is closer to a wash. Whereas for hospitality, for sure, you're going to see much higher cap rate.
Right. So last question. Yeah. So are there any bright spots at all in this whole real estate business? I mean, what excites you at this point?
Well, the clear winner has been data centers, logistics warehouse, because, well, like we talked about earlier, when people are spending a lot more time at home, they'll be buying more things online. They'll be watching more movies online. They'll be playing more games online. Students will be doing their classes and doing their homeworks online. All of that is going to require data centers. So that's a clear winner. Logistics side, because the people are buying more on online, e-commerce growth is going to drive logistics growth. Another sector which I've seen to be pretty resilient has been actually self-storage. I think, again, people spending more time at home probably want to start to store away more of their clunks to create more space for themselves, or buying new furniture, new TV, new refrigerator and whatnot, and maybe storing away the old stuff. And also e-commerce would drive some of the last mile logistics, which would be using some self-storage units as well. So very clearly we see benefits in these three sectors.
Great. Well, thank you. That's all the time we have. Thank you, Kenneth Gao of Gao Capital, for taking the time out this morning.
Sure. Thank you.